Hey everybody, it's your friend Jason Pound here answering the top asked questions by home buyers and home sellers in today's Oklahoma real estate market. Question we're tackling today, how much does 0.25% actually cost a buyer these days? Well, the short answer is it's very price point specific. As you know, math is math and you have to do some math to figure out the math. But in general, for most people in the greater Oklahoma City metro area, each quarter of a point on your interest rate costs about $60. As usual, however, let me over-explain. It's important that when you are considering buying or selling real estate, that you consider both the buy side and the sell side. Because if you're buying today, one day you're going to have to sell. And if you're selling today, your old buying experience, while transferable and applicable, is no longer accurate. And that is one of the important reasons that you hire a realtor, is they are in the market day in and day out and understand the challenges that you are going to be facing this month versus the challenges you would have faced last month. So 3 quick talking points I want to share with you. Number one, before we get into the math, number one is the sales cycle. There is a reason that your typical American gets a new home about every 7 years. And the reason behind that is when you are buying a used existing home, it takes about 5 years for you to break even. When you sell a large asset, there are liquidation costs associated with that. So even if your home does go up in value your first year, you typically can't sell that asset and capture those profits. Typically, you have to hang on to it about 5 years. When you're doing a new build, you're typically paying top dollar, the latest dollar for the latest goods and services that are available in a house. And it takes about 7 years to break even on a new build. And that's if your neighborhood has completed its construction projects. A lot of builders are stretching out what used to be 1 year phases into 2 and 3 year phases. And each phase, while taking 2 to 3 years, there are typically 2 to 3 phases to a neighborhood. You have the beginning phase at the front, the middle phase in the middle, and the back phase at the back. And each phase gets more expensive. You tend to have higher price points at the back, smaller price points at the front. It takes about 7 years to break even on paying extra for those goods and services. Number two, you must consider the rate cycle. It is called a cycle because the rates go up and down in predictable measures, typically in about 20-year patterns. Anything can affect the rates at any given time, oil and gas prices, war prices, inflation prices, things like that affect the rates, but in general, the rates tend to move in about 20-year cycles. And if we are entering into a higher part of the rate cycle, look forward about 5 to 7 years, 10 years, 15 years, and see where the rates are projected to go in the future. Right now, we are creeping into the higher part of the rate cycle right now. And more than likely, in the next 5 to 7 years, rates are going to drop. So if most people tend to sell their house in 5 to 7 years and go to a different house, there's no need to consider the 30-year calculation on the total cost of the home, because more than likely, you're not going to hang on to that loan for the full 30 years. You're going to either end up selling the property or you're going to end up refinancing the loan anyway because of where we're at in the rate cycle. The third thing to think about is the life cycle. It's important that you are always maintaining your good credit and your good cash position, because life pops out of nowhere. And there are people all day, every day that end up having to sell because of changes in their life, or they end up having to buy because of changes in their life. Families are consolidating. They're starting to buy bigger homes and combine the generations. There are other people who don't have kids and grandkids to depend on, and they're downsizing their houses and getting rid of those assets. So between the sales cycle, the rate cycle, and the life cycle, it's highly unlikely that your loan choice is going to impact you for the full 30 years. And that's why I'm comfortable looking at the next 10 years. Let's look at the math. The typical home in the greater Oklahoma City metro right now is around $330,000 to $375,000. I chose $350,000 for some easy math. That's not the price you pay for the house. This is the size of the loan. If you have a loan for $350,000 at 30 years at 6.25%, it's this price. At 6.75%, It goes to that price and it's 7.25. It goes up to this price per month. So a swing of $21.55 up to $23.87. I didn't feel like writing it all out, but basically every quarter percent that you go up, 0.25 that you go up, so from 6.25 to 6.5 goes up about $55 to $60. From 6.5 up to 6.75 goes up about $50 to $60. When you swing from 6.75 up to an even 7%, it goes up from $22.70, about $50 to $60. And up to from the 7% even to the 7.25, it brings it up another $50 to $60. So when you're doing some back of the math calculations for each quarter percent that goes up, when you're around that $350,000 mark, it's about $55 to $60 extra dollars to your monthly payment. My name is Jason Pound with Jericho Pound Realty Group. We service the entire Oklahoma City metro area with hyper-local expertise in South Oklahoma City, Moore, and Norman. And we are here today to provide you knowledge, power, because knowledge is power. And even though the rates have crept up a little bit, it's not as financially debilitating as you thought it was. So be encouraged, my friends. Life goes on. People are still buying. People are still selling. And if you're one of those, I've got my hand up. I want to be your realtor. In the meantime, peace out. Have a great life. I'm going to bust through these doors and get back to work. Ooh. Peace.